Welcome to Taking Stock. I'm Amanda Lang. Coming up on the show, Canadians are feeling the stress of high rates and spending affordability efforts where politics meets economics. Plus, when Alberta says it wants out of the CPP, maybe it's a wake-up call. That's all ahead. First, for the week that was in business, it's time for the briefs. The Bank of Canada held steady on interest rates as it continues to monitor inflation and warned that the hopes for avoiding a recession are dimming.
We've been very deliberate. We're leaving the door open to further interest rate increases because there is uncertainty about that. And if we see inflationary pressures persist, we are prepared to raise our interest rate further.
Further hikes will be painful for some. A poll by Angus Reid this week found that 15% of borrowers are finding meeting their payments very difficult, and 79% are worried about what lies ahead when it comes time to renew. Canada's big grocer CEOs are being called back to Ottawa for details of their promised plan to lower prices. All had said they would have a plan by Thanksgiving, but their individual efforts are also confidential. Meanwhile, shoppers loading up on Halloween candy will face year-over-year increases of more than 9%, according to StatsCan. A report from Food Banks Canada paints a picture of growing stress as a record number of Canadians visit food banks. Almost 2 million people visited a food bank in Canada in March, up 32% from a year before, and a 78% increase from March of 2019. A strike at the St. Lawrence Seaway disrupted a marine terminal responsible for shipments of grain, oil, and iron ore, among other things. Workers there are hoping for higher pay, while the Seaway operator argues their increases in recent years ran ahead of inflation. The port supports 66,000 jobs indirectly and contributes $34 million a day in economic activity. A strike at General Motors' U.S. operations got more costly this week after workers at one of its most profitable plants walked off the job. Hours after CEO Mary Barra said the strike was costing the company $200 million a week, GM also withdrew guidance for its profit this year, given the uncertainty around the strike. The City of Toronto unveiled an ambitious and pricey housing plan this week at roughly $30 billion. The plan to build 65,000 new units by 2030 is based on new funding from both the province of Ontario and the federal government. The city also said it would become the builder on 5 properties already identified. There was another massive deal in the oil sector this week. Chevron said it would acquire Hess for $53 billion in stock, building up its stores of oil, especially in U.S. shale. It comes after ExxonMobil's all-stock $60 billion acquisition of Pioneer Natural Resources and signals new bullishness on the part of the major oil players. And those are your business briefs. Well, wherever interest rates go from here, it is clear households are already feeling this stress. Will that be enough to change our behavior and help cool the economy? Benjamin Tal is Deputy Chief Economist at CIBC. Thanks for being with us.
A pleasure. Thank you.
So no surprise, of course, that we're seeing a growing number of households, not just stressed now about their payments, but worried about what happens, for instance, at mortgage renewal time. Benjamin, we heard the central bank talk about the risk of a soft landing and that window narrowing. When we look at how stressed people are, does that put us on the path to a recession, whether it's mild or not, because people will pull in their spending?
Yes. In fact, we are already in a recession. A per capita recession. Basically, if you adjust for population growth, GDP growth is negative, consumer spending is negative. So the only reason why we are above water is because of the fact that we got 1 million people into this country. But that's not a way to maintain economic growth. And I think that the Bank of Canada knows that. There is no question about it that the economy is suffering. Consumer confidence is in the basement. Business investment is very weak. The housing market is basically in a recession. Clearly, the economy is responding to higher interest rates. The Bank of Canada is acknowledging that, saying clearly the economy is slowing down. We're talking about less than 1% growth this year and next year, and that's if we are lucky, and per capita we are negative. But at the same time, inflation is still sticky, and the Bank of Canada is toying with the idea of raising again, which will be, I believe, a mistake.
So when we think about that per capita already in a recession, the hallmarks, of course, of a recession that will be disruptive would be job losses. We are, of course, seeing population growth. That means creation of new jobs has to be pretty high, right, just to stay level. Do we expect, though, big layoffs in the months ahead?
Well, first of all, we see the unemployment rate rising because population growth is rising faster than employment. Therefore, you have a situation in which the unemployment rate is actually rising because of that. I do believe that the unemployment rate will continue to rise. That's exactly what, by the way, the Bank of Canada would like to see. The labor market is too tight as far as they are concerned. Wages are still rising by 4 or 5%. They would like to see it slowing, and it will. With the economy slowing, with consumer spending slowing, with investment slowing, there is no way in which the labor market will continue to be so strong. So this labor market will start weakening. That's exactly what the Bank of Canada would like to see.
So we do have a fall fiscal update in the weeks ahead, Benjamin. Would you expect the government to be tempted to offer more to help Canadians on the affordability front, or would that actually be a dangerous thing when what we're trying to do is actually cool the economy?
Yes, we have to be very careful here because if you try to help on the one end, the Bank of Canada will have to continue to raise interest rates and the impact will be more significant. So I think we'll have a situation in which the fiscal update will be mostly about housing, quite frankly, and not to increase supply. I think that will be the focus.
And of course, that would be a relief to the central bank. Given where we are now, do you have guesses about how close we are to being finished in terms of rate hikes and when we might even start to see declines?
I think we are done. The Bank of Canada will remain hawkish because he wants to keep us guessing. But I think the Bank of Canada is done. Inflation is starting to move in the right direction. The economy is basically approaching a recession. They know that enough is enough. The question is, when are you cutting? And remember, another way of overshooting is to keep interest rates high for longer than needed. And I think they will do it. I think that not before June, July, are we going to see the start of an easing trajectory in interest rates. So we still have a lot of time with those extremely high interest rates. And remember, those mortgages are being renewed on a daily basis. So
good to have you, Benjamin. Appreciate your time.
A pleasure. Thank you.
Benjamin Tal, Deputy Chief Economist at CIBC. Still ahead, there's a lot of talk about how unaffordable life is. We're taking a look at the politics of affordability next.